All right, let's dig into the latest earnings from Core and Main. The market definitely had a strong reaction to this report, and for good reason. We're going to break down the results, what's driving them, and what it all could mean for the stock from here.
Okay, let's jump right into the numbers, the ones that really lit up the trading screens. So here's the headline that really turned heads, a massive beat on the bottom line. Core and Main delivered adjusted earnings of 89 cents per share, which absolutely smashed what the street was expecting by about 26%. You know, in a market that's really rewarding solid execution, a beat like that is a huge deal.
And you can see exactly how the market felt about it. Investors piled in, sending the stock soaring almost 9%. And look at the volume, more than double its daily average. This wasn't just a little bump, it was a high-conviction move by the market. So, the big question is, how did they pull off that huge earnings beat? Let's peel back the layers on the financials, because what's really interesting is that the strength wasn't really coming from the top line. And this is really the heart of the story right here. Net sales were basically flat, up just a little over 1%. But look at the gross margin. It expanded by 60 basis points. That's a clear signal that this team is laser-focused on profitable growth, not just chasing sales for the sake of it.
Now, this kind of margin performance doesn't just happen by accident. Management is pulling some very specific, very deliberate levers. They're staying disciplined on pricing, they're actively shifting their product mix toward higher margin specialty items, and they're growing their own private label brands, which are now on pace to be about 5% of their total sales.
And all that hard work on margins, well, it translates directly into what so many investors care about most: cold, hard cash. The business is just cranking it out, generating a really powerful free cash flow yield of 5.6%.
And just to put that number into perspective, it's not just good, it's outstanding. It's more than double the average yield of the entire S&P 500, and it blows away their direct competitors. I mean, this is what a true cash-generating machine looks like.
So what's the strategy driving these fantastic results? Well, it really boils down to two things: a really smart, diversified business mix, and a super disciplined approach to how they use their money.
The company's resilience really starts with this chart. Look how balanced they are. You've got municipal projects and non-residential projects each making up about 40% of sales. That creates this really stable foundation that helps offset the slowdown we all know is happening in the residential housing market, which is now less than a fifth of their business.
And within those stable markets, they're riding some pretty big waves. We're talking about all that government money flowing into infrastructure projects and, of course, the absolute boom in building new data centers. Both of those are driving really steady demand for their products.
And hey, don't just take my word for it. The CEO, Steve LeClaire, he put it perfectly on the earnings call. He's making it clear that Core and Main is built to be a resilient business, not a cyclical one. It's designed to perform well no matter what the broader economy is doing.
And they're certainly not just letting all that cash they're generating sit around. They have a very clear three-part plan for it. First, look for smart acquisitions. Second, invest in their own business by opening new branches. And third, return capital to shareholders. And they backed that last one up with a newly expanded, massive $1 billion share buyback plan.
All right, so let's pull all of this together. What does this mean for the stock going forward? Here's our take on what we're looking for ahead of the next report.
So, before we give our rating, I just want to be really clear about what we mean by the term outperform. When we use that word, we're not just saying we like the company. We're making a formal call that we expect the stock to deliver better returns than the broader market over the next 6 to 12 months.
So, our forecast from here is pretty straightforward. For the next quarter, Q4, we're expecting results to come in right in line with the guidance they just confirmed. As for the stock, we think it'll probably chop around a bit and consolidate these big gains before it starts to grind higher as the company just keeps on executing.
Which brings us to our official rating. When you look at their proven ability to control margins, that powerful free cash flow generation, and their clear commitment to shareholder returns, for us, the rating on Core and Main is a confident outperform.
All right, for this last part, let's put on our portfolio manager hat for a minute. Based on everything we just saw in this quarter, here's one potential way you could think about structuring a trade. Right, the question for any active investors is, how do you take this idea and structure a position that captures the upside while maybe protecting yourself from some of the broader market risks?
Well, one idea is something we'd call the compounder arbitrage. It's a classic pair trade. You go long Core and Main, and at the same time, you short a basket of other industrial distributors, specifically ones with weaker margins and more sensitivity to the ups and downs of the economy.
Now, the logic behind this is really key.
This trade is designed to profit from Core & Main's superior execution while hedging you against a market downturn. See, if the economy slows down, it would probably hit those weaker, more volatile competitors much harder than it would hit a resilient business like Core & Main. So it's really a pure bet on quality winning out in the end.
And of course, we always have to end with this reminder. This has been an educational analysis, a thought experiment. This is not financial advice.